Morning, ladies and gentlemen. Thanks for joining us to have a look at the tax highlights. In the budget for 2016, it is clear that although the Davis Tax Committee did not recommend introducing a wealth or capital tax, the substance of both the DTC proposals and the proposals by the Minister in yesterday's budget speech are exactly that, a wealth tax. With the increase in CGT rates, transfer duty rates, the special VDP for offshore assets, the continued attack on SA trusts, and the clamping down on offshore structures, what other conclusion can one possibly come to? Before I start off with the tax budget highlights, I'd just like to touch on the recommendations of the Davis Tax Committee regarding specifically estate duty. Just by way of background, as you know, the Davis Tax Committee was charged with looking at, amongst other things, estate duty and possibly introducing a wealth tax. The initial report came out in the middle of July 2015 and has been subject to much comment and conjecture. Comments needed to be submitted by the 30th of September 2015, and we still await report back following these comments. We do anticipate that some of the comments and proposals of the Davis Tax Committee will be introduced with the legislative changes that will follow the budget speech. One of the first proposals and the most profound proposals of the Davis Tax Committees was vis-a-vis local SA trusts. They initially proposed abolishing the conduit principle, which, as you know, the conduit principle is used, generally speaking, to vest, for example, a capital gain in a year of assessment in a resident beneficiary, thereby giving rise to a lower capital gains tax rate as opposed to taxing it in the trust. The proposal was met with much objection. It was claimed to be retrospective legislation, unconstitutional, and in contradiction to well-established case law as well as international law. In early December, Judge Davis had a webinar with the site members, and in an informal report back following the comments received in respect of the DTC report, they did indicate that in all likelihood the abolishment of the conduit principle would not apply, which was a welcoming suggestion or proposal. However, as we'll see in the budget speech, the attack on SA trusts continues. Another interesting proposal was the proposal vis-a-vis estate duty. The DTC decided to continue with estate duty and not introduce a wealth tax. What they said was estate duty, this was the initial proposal in the report, the estate duty rebate would increase from 3.5 million to 6 million per person. The spousal rollover relief would remain. That's where the unutilized portion of the rebate rolls over to the surviving spouse. But they proposed repealing Section 4Q, the spousal exemption, which is quite a blow to estate planning. At the same webinar, Judge Davis indicated that they had revisited the estate duty proposals in the initial report, and they were looking at possibly increasing the rebate to 15 million per person. However, they would then abolish the spousal rollover relief as well as the spousal exemption. What happened, and on top of it, if you'll recall, the DTC report, they initially said the estate duty rate would not increase and it would remain at 20%. A subsequent proposal is that the estate duty rate would increase, but it would be a staggered increase, so it would be 20% up to a certain point above 15 million and possibly 25% thereafter. Finally, the comments on donations tax. The proposals here were that the current exemption from donations tax, where assets are donated which are inherited from non-residents or accumulated before a person became a resident of South Africa, would no longer apply. Similar exemptions would be abolished in the Estate Duty Act. And one very interesting proposal, which we've yet to see whether it is introduced is that donations between spouses would remain tax-free, but not donations in respect of fixed property or shares in companies. We'll see what happens as far as the DTC proposals are concerned. However, I think it is important to consider these proposals as they will be implemented to a lesser or greater extent in the coming legislative process. Now let's touch on the budget speech proposals. One of the most important proposals and announcements of the Minister in yesterday's budget speech was the proposal for a special VDP for the disclosure of offshore assets and income. A media statement was released yesterday afternoon as well, and in line with the new global standard for automatic exchange of information between tax authorities, which will be introduced from the end or implemented from the end of December 2017, SARS kindly allowed for a further tax amnesty similar to the one introduced in 2003 for offshore assets and offshore income. The reason for this is also in line with the findings of the DTC, Davis Tax Committee, which indicated that there is still significant offshore assets and offshore income, which people are trying or they want to disclose, but the VDP process is too onerous, considering that some of these assets, offshore assets and income, date back to 1960s, 1980s, and the interest that would accumulate together with the penalties would just wipe out the entire wealth. This new special VDP, or the tax amnesty, is applicable to individuals and companies. It is a tax and an exchange control relief, and the window period is from the 1st of October 2016 to the 31st of March 2017. It's similar to the previous tax amnesty, where you can apply initially on a no-names basis to see what approach the VDP unit would follow, or you could apply on a representative capacity, and the normal VDP process would be followed. It is not applicable to trusts. However, settlers, donors, deceased estates, and beneficiaries of foreign discretionary trusts may approach the VDP unit, provided they elect that those assets are then regarded as theirs. The special VDP would not be applicable in the case where there is a pending audit or investigation, or an audit or investigation that has in fact commenced, or where SARS has obtained information under the International Exchange of Information. If you'll recall, this was, for example, in the case of HSBC accounts that were handed over to SARS towards the end of last year. The tax relief that's offered under the special VDP is the following. Only 50% of the amount that was used to fund the acquisition of offshore assets before the 1st of March 2015 would be included in the taxable income. Any investment returns in respect of offshore assets from the 1st of March 2010 would be included in taxable income, and any investment returns before the 1st of March 2010 would be exempt. The interest on the tax debts arising as a result of the above would only run from the 1st of March 2010. There would be no understatement penalties, and there's no criminal prosecution. The exchange control, in terms of the Exchange Control Act, application would have to be made under Regulation 24 of the Exchange Control Regulations to the South African Reserve Bank. It would be applicable to contraventions prior to the 29th of February 2016. There would be a 5% levy raised on the market value of the assets as at the 29th, or the income as at the 29th of February 2016, if those assets or the income is repatriated, and 10% where the assets are not repatriated. The levy has to be funded from offshore sources. If it is funded from local sources, an additional 2% levy would be raised. The SARB have made it clear that you cannot reduce the levy with your foreign capital allowance of 10 million rand, and no offset of fees or commissions will be allowed. I'm sure you all saw the highlights with regards to capital gains tax, which was quite a significant proposal in the budget. I'll run through the increase in the rates with you. For individuals, the inclusion rate was increased from 33 1/3 to 40%, giving rise to an effective tax rate in the hands of an individual of 16.4%. For companies, the inclusion rate went from 66.6% to 80%, giving rise to an effective CGT rate of 22.4%. For trusts, also, inclusion rate went up to 80%, with an effective CGT rate of 32.8%. The annual exclusion rate increased from 30,000 to 40,000, and these amendments are effective the 1st of March 2016. So if one wants to do some planning, some assets that you're considering disposing of, it might be worthwhile looking at disposing of them now before the 1st of March 2016 to take advantage of the lower CGT rate. Transfer duty. Transfer duty was introduced for property sales above 10 million rand. This increased from 11% to 13%. This is also effective the 1st of March 2016. Trusts, SARS's bugbear. They've continued the onslaught on trusts. This is nothing new. Trusts have been attacked in almost every single budget ever since I've started practicing. We've yet to see many of the proposals actually coming through from a trust perspective. Obviously, SARS is looking at trusts in more detail. The new trust return is far more onerous, a lot more reporting requirements. In fact, most trusts nowadays, trust returns, we find that they are labeled for audit almost immediately, whether it's in a refund position or a payable position. And SARS sometimes sits for 2 years auditing these trust returns. One of the proposals, which I'd like to see how it is introduced, is that interest-free loans to trusts will now be regarded as a donation and subject to donations tax. And the capital portion of the loan would be included in the estate of the lender. Now, this, in effect, gives rise to double taxation. We'd have to see how they actually implement this. I'd be very surprised if it is implemented. They also, a very broad sweeping statement was that further anti-avoidance measures would also be investigated vis-a-vis trusts. Multinational companies continue to be in the limelight. SARS is targeting unacceptable transfer pricing practices, making use of the treaty shopping by taking advantage of tax-sparing clauses without any substance in a country where the treaty is used, and highly geared financing structures where excessive interest deductions reduce tax liabilities. SARS's target will be achieved by improving the quality of the reporting requirements of multinational firms to SARS. Transfer pricing documentation will have to be submitted in respect of every country in which a multinational has a presence. The enhancing of the controlled foreign corporation rules to ensure that income in respect of offshore companies where the company does not have substance is imputed back to the South African resident shareholder. And they will continue to introduce rules which limit excessive interest deductions. Personal income tax, there wasn't much change to the personal income tax brackets, marginal increases to lower income tax brackets. Primary rebate increased to 13,500. Secondary rebate remains at 7,407. Third rebate remains at 2,466. The tax threshold was marginally changed. It was increased to 75,000 of taxable income per year for those under 65. For those between the ages of 65 to 74, it was increased to 116,150 rand. And for those over 75, it was increased to 129,850. Medical tax credits, these increased from 270 to 286 rand for the first two beneficiaries, and increased from 181 to 192 rand for additional beneficiaries. Retirement savings, as you are well aware, there's a significant change which will be introduced with effect from the 1st of March 2016 with regards to retirement RA contributions as well as Provident Fund contributions. Just touching on it briefly, is RA and Provident Fund contributions made by employers on behalf of employees will now be taxed as a fringe benefit in the hands of the employees. The employees are, however, entitled to a a deduction, an equivalent deduction, so they should be in the same position. However, this deduction is limited to 27.5% of the total remuneration, the greater of the remuneration of the employee or their taxable income, and this would be capped at 350,000 rand. The proposals in the budget speech from yesterday were merely addressing some of the anomalies that exist in the current legislation to be introduced on the 1st of March 2016. The controversial Provident Fund amendment relating to annuitisation has been postponed from 1 March 2018, which is no surprise given the political impact. International tax. The withholding tax on services, if you'll recall, the withholding tax on management fees that was to be introduced with effect from the 1st of March 2016 has been withdrawn, and this will now be dealt with in the Tax Admin Act. We'll have to see how they propose to deal with it in the legislative changes that are coming. With regards to CFC legislation, controlled foreign companies, as you're aware, a CFC imputes income from its offshore company, is imputed back to the South African shareholder, and the South African shareholder is then taxed on this imputed income, subject to certain exemptions and exclusions. There have been problems actually applying this in the case of collective investment schemes, as it's questionable who should actually be taxed on the imputed income, whether it should be the local investor or whether it should be the local fund. SARS says the Minister proposed exemption with regards to collective investment schemes and the CFC legislation. Interest withholding taxes. How interest withholding tax works is it's payable when the interest becomes due and payable, so not necessarily when it is paid. So there have been situations arising where it has become due and payable, the interest withholding tax has been paid to SARS, however the debt afterwards becomes irrecoverable. There was no refund mechanism in the legislation. This anomaly will be addressed. Learnership and employment incentives. The learnership allowances have been quite a successful incentive that was introduced by SARS some time ago. This will be revisited and may be extended for a further year until the report back from the SARS Investigative Committee has been presented. Bursaries fringe benefit tax exemption threshold has increased from 250,000 to 400,000. And the value of business qualifying bursaries has increased from 10,000 to 15,000 for National Qualifications Framework levels 1 to 4, and from 30 to 40,000 for levels 5 to 10. The research and development incentives, SARS is not entirely happy with the use that has been made of the research and development incentives. It's been applied to a limited extent, and this is purely because of the administrative burden on companies as well as the backlog at the Ministry of Science and Technology. As to qualify for the R&D incentives, you have to get pre-approval from the ministry. A committee will be tasked at investigating and possibly simplifying this process. With regards to mining companies, the infrastructure investment which mining companies are required to invest in uplifting the communities, mining communities, historically did not qualify as a deduction for such mining entities unless it was for the upliftment of employees. This will be revisited and a deduction will be allowed. Incentives for a cleaner environment. The new fuel specifications require that a further 40 billion investment needs to be made by oil refineries. In order to encourage this investment, SARS has introduced accelerated allowances of a write-off of this qualifying expenditure over 3 years as opposed to the usual 5-year period. With regards to renewable energy incentives, these will be extended to necessary indirect infrastructure, for example, the development of roads or erection of fencing, which previously was not allowed as a deduction. Fuel taxes. The general fuel levy was increased by 30 cents per litre from the 1st of April 2016, and the road accident fund levy will be increased by 50 cents per litre. There's also a tyre levy that has been introduced of R2.30 per kilogram of tyre from the 1st of October 2016. Incandescent globe tax increased from R4 to R6 per globe from the 1st of April 2016. Plastic bag levy increased from 6 to 8 cents per bag from the 1st of April 2016, and an increase in the electricity levy from 3.5 cents to 5.5 cents. Promoting public health and social well-being. To counter obesity, a tax will now be levied on sugar-sweetened beverages with effect from the 1st of April 2017. And a further increase of 7% in the usual sin taxes was introduced. With regards to your tax-free investment of 30,000, there was a loophole that taxpayers were taking advantage of. From an estate duty perspective, a taxpayer could nominate a beneficiary on the endowment policy and thereby circumvent estate duty. This loophole will be closed. And the requirement to submit an exempt dividends tax return in respect of these tax-free investments has been removed, it was just an onerous, burdensome process. With regards to foreign employers, where foreign employers do not deduct PAYE, the local employees will now be subject to provisional taxes. A typical avoidance scheme that has been utilized frequently in the past, and SARS has tried to clamp down on, they will investigate clamping down further. This is typically where a target company will buy back shares from a seller, and in certain circumstances, the seller then qualifies for a dividends withholding tax exemption, for example, if it's a company. And the buyer is then issued with new shares in the company, thereby shares changing hands. The issue of the shares creates contributed tax capital, which when returned to the buyer has no dividends withholding tax or capital gains tax implications. This loophole will be closed. Third-party backed share provisions, just basically some background to these provisions. This is where typically you have a preference share where the dividend yields are backed by a third party. In such circumstances, it's a very specific provision. The dividend income is regarded as income and not dividends withholding tax. A scheme has been introduced whereby trusts are interposed. These trusts hold the preference shares that are backed by third parties, and the investors then hold participation rights in the trust. This anti-avoidance provisions will be introduced to close this loophole. REITs. Currently, if you hold an investment in a REIT, the income that you receive is taxable dividend income. However, there's no allowance for deduction of expenditure incurred in generating this taxable dividend income. This is clearly an oversight, and amendments will be introduced so that expenditure is deductible. Hopefully it would be retrospective, but that's not clear at this point. VAT. There were a few interesting amendments on or proposals with regards to VAT. Non-executive directors' fees, there's always been controversy whether these should be subject to VAT or whether they should be subject to PAYE. This will be clarified by SARS. Loyalty points programs are currently not subject to VAT. This will be investigated and reviewed. The determination of the value of a company car for VAT purposes is different from the formula that's used to determine the value in terms of the 7th schedule for the fringe benefit tax. This creates an onerous administrative burden on taxpayers, and it's been proposed that the VAT section is brought in line with the 7th schedule, and that the formula applied for fringe benefit purposes is now applied for VAT purposes as well. An interesting proposal, which I'm not sure how SARS is actually going to implement, is, as you, I'm sure, know, you can roll VAT inputs for up to 5 years, and in practice, it's done to ensure that you're not necessarily in a refund position. SARS has looked at this, and they, in certain instances, they said, not in all instances, they will no longer allow a rolling of VAT input, and the claims must now be made in the period in which the supply is actually received. How this will be implemented, I'm not sure. Tax administration. As you're aware, the 30 business days, you're allowed 30 business days in which to submit your objection to an assessment. The proposal is to increase this period, as SARS has been inundated with requests for condonation for late submission of objections. The period is much too short, especially if you consider that SARS has 60 to 90 days in which to respond to your objection. The VDP, you cannot apply for VDP if there is an audit pending. What is meant by a pending audit will be clarified in the legislative changes. Well, that brings me to the end of the tax highlights. It was a very brief budget speech, which was presented by Mr. Gordon, with few surprises, as was expected for an election year. Thank you very much.